In this video, we'll be walking through a debt term sheet for a senior lender working on a private equity transaction, which is important as you start to evaluate capital structure options, because there are a few things it helps to be aware of. In addition to the process described in the lesson titled Lender Engagement, the first is that the capital stack should be approached in order of seniority. To understand why, think about a capital structure that combines senior debt, subordinated debt, and equity. The protections available to each of the capital sources will vary based on the risk assumed and the potential for yield. Senior debt, being the most secure source of capital, will require assurances unavailable to the subordinated lender. But a subordinated lender will find it difficult to provide terms without any knowledge of the senior lender's expectations. In the senior lender term sheet example included as part of this lesson, you will see financial covenants that can impact the subordinated lender. The most obvious is the total leverage ratio, which limits the amount of funded debt as a multiple of EBITDA. And the remedies available to the senior lender in the event that this covenant is breached can potentially put all subordinated capital, which in this example includes both subordinated debt and equity, at risk. Consequently, the subordinated lender will need to know what the senior lender expects. And this dynamic brings me to the next point. Once the sponsor has identified the lender firms they would most like to work with, it's critically important to confirm that these lenders are willing to work together. In addition to drafting the credit agreement for each tranche of debt, legal counsel for the lenders will draft and negotiate what is known as the Inter-creditor agreement. We will provide more information on this document in a future lesson, but for now, it's important to note that a strong disagreement on this front late in the process can kill a deal. I actually once worked on a transaction where every item had been negotiated and all documentation was drafted and in final format, but a single number in the subordination and inter-creditor agreement nearly caused the entire transaction to fall apart. And had it not been for a partner's relationship with the C-suite of the senior lender we were working with, we would have lost the investment and we would have had to absorb substantial dead deal costs. So with that in mind, let's take a look at the senior lender term sheet. The term sheet in its entirety is a little more than 2 pages in this example. To emphasize the important details only, most term sheets take a bulleted approach to presenting information, with the important variables in bold text. Now, for starters, let's focus on the information available in a senior term sheet that is relevant for financial modeling purposes. Listed in the order that it appears in the senior lender term sheet attached, the details that follow should be incorporated into the financial model. The amount of the loan, which is equivalent to $25 million. The maturity, which is 5 years from closing. The cash flow sweep, which is 50% of excess cash flow. The amortization schedule, which communicates how much of the loan must be paid off each year. Next, we have the term debt pricing. And this is the interest rate. And in this example, a benchmark rate has not been included. But per the explanation in the lesson titled Lender Engagement, this would normally be expressed as a benchmark rate, such as LIBOR plus a fixed rate. After that, you have the financial covenants. And finally, any financing fees, which in this example includes a 1% origination fee. In addition to the information available in this example term sheet, you would also want to ask the lender about the borrowing base available in the line of credit. In this term sheet, it is expressed as a fixed sum of $5 million, but this will generally be tied to working capital accounts. By way of example, this might be limited to 80% of eligible accounts receivable. Now, as a quick aside, when you're working on a transaction, it's highly unlikely that you'll be looking at a single term sheet. You will probably be evaluating multiple term sheets against each other. To do this quickly, it helps to have a schedule that facilitates cycling through the available options. The Excel file available for download as part of this lesson provides a template with video instruction that's helpful for this purpose. And with this structure in place, you can then compare the impact that each term sheet has on returns, cash flow, and the financial covenants provided by the senior lender in your LBO model. And what you will often find is that the term sheet that maximizes the internal rate of return may not be the most prudent option. For a junior team member, this is a terrific exercise to better understand the relationship between risk and reward. Increased leverage will improve the return to equity investors, which is the reward portion, but it will also make the business more sensitive to any volatility in revenue and earnings by increasing the likelihood of breaking financial covenants in the projected period, which is the risk portion. Now, the term sheet is available for download, so please be sure to take advantage. Spend time familiarizing yourself with each of the concepts addressed. whereas a junior team member is likely to only require the information relevant to the LBO modeling exercise. In a more senior role, all of the additional detail will be highly relevant as a blueprint for the negotiation surrounding the credit agreement. All right, team, that's all for now. Thanks for watching.